Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, when talking about implied volatility, basically what you want to do is you want to create an opinion on that, just like you would a stock or the spot price of the FX options or anything else that you're trading. You want to come up with a plan, an idea of what you think that price is going to do. So here, not only do you want to do that for the underlying, you want to do that for the options volatility, the implied volatility. And there's many different ways to do this. I'm just going to highlight 3 of them right now. So the first way, something that many of us have heard of, is a comparison between implied volatility and historical volatility. So some will say, if implied volatility is lower than historical volatility, then the options are undervalued and maybe is a good time to buy options. And the reverse also, if implied volatility is above historical volatility, then it may be a good time to sell options. Another way is people will look at the actual number of the volatility. So they'll make a judgment call and they'll say, well, if it's a 30 vol, and that number is actually a percent, so it's 30% as an annual number, they make a call about the number 30 or the number 50 or the number 10. And so they're saying that the number 10 is low, the number 30 is high. And then finally, there's a third way that's pretty common that you may not be aware of, and that's called relative implied volatility analysis. And this is what we're going to focus on today. All right? And I'm going to take you through some steps to help you understand it and help you apply it. So basically, what relative implied volatility analysis is about is it's kind of like when you go to the mall and it's so big, you don't know where you are exactly and where the store is that you need to get to. So what do? You go up to the kiosk and you look for the big map and you're looking for the "you are here" symbol, right? Well, why do you need to know? Well, you need to know where you are, and then the next thing you need to do is you need to find the store that you want to go to, right? Because now you have your location in relation to the desired outcome. So once you do that, then you can come up with a plan as to which way you have to walk to get to that store. And what we're going to do is draw a map about implied volatility, and that's going to help you do the same kind of thing. If you have an idea about where volatility has been, maybe you can make an educated guess about where you think it's going. And the reason you want to do that is because implied volatility is going to affect the price of the options contracts that you're trading. And so if you can get the gears working all together at the same time, and the gears being, in this case, just simply stated as what the spot price is moving and what the implied volatility of the contracts is doing that you're going to trade, if you can get those gears moving together, you have a better chance, you have better odds of being successful when you trade. Okay, so here we have a chart, and this is from TradeKing.com, and it's under our quotes and research section, and it's a volatility chart. And you can get a volatility chart on any symbol that offers options for trading. And this is a free service. Like I said before, if you open an account, all the services are free, so check it out. And what you're going to do is, let me just define what we have here. So this is a volatility chart for the EUI, right? So this is regarding the euro and the US dollar relationship. Now, it's a 1-year chart. Okay, that's what I highlighted here. And you have 2 lines here. The gold line is the implied volatility line. This is a map of the option volatility. And it's calculated from using call and put prices of the first couple months near the at-the-money options. The white line says HV, and that stands for historical volatility. And that has to do with the fluctuation of the spot price for the same time period. What I want to make clear, though, is that nowhere on this chart is the underlying of the spot or the symbol EUI, okay? It is not on here. This is only a volatility chart. This is something that I've often received questions about, so I just want to make sure to mention it here. So what we're looking at is, you can see that it was pretty low. We're going to focus on the gold line. So it was pretty low back in last summer. And then as the whole rest of the financial world became unglued, volatility spiked in FX options as well. Okay, and that's not really surprising. I mean, this was a pretty severe event and global, far-reaching, and therefore, and so forth. So it's not unusual to see something like that. And then lately, you can see the volatility has somewhat subsided. It's come back down to the lows, but not nearly as low as it was before. So mean reverting, which is what I mentioned before, says when you are make some marks here. Mean reverting is talking about moving between kind of the highs and lows like this. And it tends to just come back to the middle. It's not going to look as nice and neat as this drawing of mine, but you get the idea. It's moving between the highs and the lows. So what we're going to do is we're going to draw out the highs and the lows of the implied volatility line. Now, if you're not confident in your drawing abilities, or you don't feel like you can estimate what the number on the side is, that's fine. We do have the numbers on our site, but just to be more clear, I put them in here so that you could see them all. Okay, so what we're doing is we're identifying the high and the low of the range of the last year. Now, what that is going to tell us is the range here was between 8 and 30%. Okay, and then we need to take the width of that range. Okay, and that was 22. It actually should say 22 percentage points. It shouldn't really be 22%, so I apologize for that. That's the width of the range. The next thing you're going to do is you're going to divide that number of 22 into 3 parts. Okay? Now, I'm using 3 because I'm just giving you a somewhat simple way to understand this. Okay? So basically, it's 3 because I told you it is. All right? And that number comes out to 7.3. And that defines how wide 1/3 of that range would be. And that number is then used to define the upper and lower portions of the whole range. And you'll see what I'm talking about in a moment. So here we have our lines that we had drawn before. And if I add in 2 more lines, now we can see that there are 3 parts of this volatility chart. Okay? So, because what this is doing is giving you some perspective of like how far the space is between the high and the low, and then you can come up with ideas as to what to do when volatility is in one of these thirds. All right? So you can see here that the implied volatility is right around 15%, which happens to be on the border between the lower third and the middle third.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.